A very warm good morning to all of you. I'm extremely delighted to be here and thank Mr. Goenka for that introduction. And many of you are known faces. I have interacted with you, so I'll try and make it as interactive as possible. I have a prepared speech, which of course I will be reading out and will be speaking intermittently. But I think an event like this to be organized in Mumbai by Financial Express, I would like to compliment the organizers for having taken this initiative. And it's quite actually a very important, at a crucial juncture, we are talking on a theme like modern BFSI. A reference was made on inflation, but I'm not talking about inflation in my address. Maybe there will be some questions later on when I can take it. So as I said, it's my pleasure to be here amongst such a distinguished gathering that we have here to deliver the inaugural address of the Financial Express BFSI Summit on Disruption and Opportunities. In fact, this theme resonates so well in the current context of technological innovations and new business models which are coming into play almost at regular frequency. The impact of COVID-19 pandemic, the recent geopolitical crisis, and the all-pervasive technological innovations sweeping across economies are challenging the traditional financial intermediation processes like banks, or for that matter, the old type and the existing NBFCs or the housing finance companies and other financial intermediaries. In my address today, I would like to focus more on banking and financial services space, quite naturally, and I propose to share some thoughts on possible implications of technology on the financial services industry in the days and months and in the years to come. Now, the banking paradigm is undergoing a major change. The edifice of growth and development in modern economies is built on the foundation of a vibrant, resilient, and well-functioning financial sector. The core functions of financial sector in an economy, namely intermediation, asset price discovery, risk transfer, and payments, are globally undergoing a process of transformation. This is primarily driven by technological advancements. The Indian financial sector has also been a part of this process of churning and is adopting and propelling these transformations. Over the past few years, the business of banking has witnessed a shift from traditional branch banking to digital banking. The paradigm shift has been possible due to innovations in information technology, that is particularly in the IT space, growth in mobile and internet connectivity, market-based financial intermediation, and above all, the advent of fintech. Financial service providers are now devising new products and services and are adopting new business models for reaching out to their targeted customers. Improvements in technology have also enhanced the cause of financial inclusion and technology-enabled public goods delivery. The direct benefit transfer through digital mode is among the best examples of technology-enabled public good delivery. Digital, mobile, anywhere, anytime banking. I repeat, digital, mobile, anytime, anywhere banking is becoming the order of the day. The indigenously developed UPI and the Aadhaar-enabled payment service, that is AEPS, have become the backbone of our retail payments system. Along these developments, the Reserve Bank's regulatory approach has been aligned to support and foster such developments. The technology guidelines, or the regulatory guidelines for account aggregators and peer-to-peer lending operators are indicative of a proactive regulatory approach that the Reserve Bank has adopted over the years. An enabling framework for regulatory sandbox has also been put in place for last 3 years. And as you would be aware, we have also set up the RBI Innovation Hub at Bangalore to catalyze innovations and investments in the fintech sector. We are now moving towards central bank digital currency. Now, while I have just tried to highlight the kind of transformations which are taking place in the entire financial sector, in the financial services sector, and changes which are primarily driven by technology and their application, I would now like to focus a little bit on technology as a disruptor and what are the opportunities and challenges it offers. Every technology brings with it a lot of opportunities. At the same time, it brings with it a lot of challenges. It's the first opportunity is for the promoter and the major players. The opportunities have to be capitalized by industry players. And at the same time, there are challenges which the industry players will have to be mindful of. The second challenge is to authorities and regulators. Authorities and regulators are required to provide an enabling environment where such players and investors can exploit the opportunities, but at the same time, it is also the responsibilities of authorities and particularly regulators to ensure that there is appropriate risk management. So when we are talking of challenges and opportunities which fintech is throwing up today, it applies both to the major and minor players in the sector as well as to the various authorities and regulators, depending on which sector, depending on which subsector or which area one is talking about. Now, with the advent of new technologies, we are witnessing a new era of disruption. Given the growing role of technology, data and network and their effects, there is a feeling among the banks that having an ethos of a technology company while offering banking services is the need of the hour. This is an area of opportunity for the banks, but there are also, as I mentioned, associated challenges which need to be mitigated. Greater attention needs to be given for building customers' trust by, I will mention 3 factors. Greater attention needs to be given to build customers' trust by, number 1, offering products and services appropriate and fit for customers' needs and circumstances. 2, ensuring robust security controls, reliable and efficient delivery of services, transparency of terms and conditions to customers. And 3, by handling the customer grievance satisfactorily and building necessary awareness among the customers. All these aspects need to be factored in when financial institutions introduce or enhance technology-driven products and services. Talking about opportunities, it would be relevant to note that what we have seen until now and what we see today could just be the tip of the iceberg. The use of artificial intelligence and machine learning to determine the creditworthiness of clients for small ticket loans by analyzing data from a wide range of traditional and non-traditional data sources has indeed the potential to enhance access to credit, especially for the marginalized sectors and the marginalized customers. Here, also, it would be essential and necessary to understand the associated risks and mitigate them suitably through various safeguards and precautions. Risks relating to cyber security, software development, limitations in transaction capacity, privacy of customer data and data security need to be factored in. The methodology of algorithms underpinning digital financial services has to be clear, transparent, explainable, and free from exclusionary biases. The credit scoring models using innovative techniques can be useful, but they should be subject to a robust model governance framework. Comprehensive assessment of risks has to be undertaken while planning to move to cloud with customer sensitive data. So as you have seen, what I have been attempting to, do is that pointing out areas of opportunities. First, I talked about, for example, the need and the feeling among the bankers to, adopt more of technology, to become, not just remain as banking services companies, but also to become, if I can use the word, a technology company, because a technology-driven company as well as a technology company, and to deal with the associated challenges. Then I mentioned about the new technologies which are coming about, with regard to artificial intelligence, machine learning, the way they can be utilized, exploited, and the challenges they offer. And all these things, I must mention that all these improvements have also enhanced the cause of, as I mentioned a little while ago, financial inclusion and tech-enabled public goods delivery. So, and therefore, in all these digital initiatives, the plan should also factor in the sets of customers who may not be digitally savvy and who may want to engage physically with the bank. So I'm not saying that the physical presence of a bank is going to become irrelevant. Probably the dependence on a physical branch will reduce as people become more technologically aware, as people start using more of technology, because ours is a huge country and the penetration of technology is not uniform across the country. But going forward, as and when the education level, the technology awareness levels, and as and when people start using more of technology to avail various kinds of banking services, including lending, repayment of loans, deposit, deposit withdrawal or whatever, then there will be a shift towards digital banking, more and more of, branchless banking. But I think in the foreseeable future, the branch has a relevance. And also eventually when technology has spread, I would say when technology has even penetrated to its deepest levels, I think physical branch presence will have its role in terms of customer interface, in terms of understanding the customer's requirements, in terms of engagement between the customer and the banker, which is very essential to see that investments are made appropriately, to ensure that there is proper due diligence. When a loan is sanctioned, the bankers tend to do, and they must do, there is a process of interaction also gives the confidence to the banker about the creditworthiness of the borrower. There is something called the body language in every interaction. In every interaction between a lender and a borrower, or in any interaction, each party to the interaction is watching the body language of the others. So therefore, I think it is the body language which, I must say, the machine interaction or the IT interaction cannot capture. And it is very essential. It may sound a bit esoteric what I am saying. I think in real life situations, you take any field, when two people are interacting, when two groups are interacting, there is an analysis of each other's body language, and you get a feeling of comfort or discomfort only after a physical interaction. So therefore, what I'm trying to say is that technology will gradually spread. The need for physical branch presence may go down, but physical branches will continue to have their relevance in the years to come. The IT systems and platforms are also exposed to obsolescence and require frequent upgradation. In fact, this calls for adequate investment in technology, and in all our interaction with banks and NBFCs and other financial sector players who are under the RBI's regulatory domain, we have been impressing upon the players to invest more on technology and so that they remain relevant. An associated area is also building up adequate and the appropriate human resource for all this. Now, in the recent days, we find that there is collaboration between finance and technology firms. One aspect is the NBFC or the bank adopting technology itself and using that as a method. The other one is the collaboration between finance and technology firms, the financial services firms, including banks and NBFCs, and the tech companies. Large technology companies like, that is the big tech, which have entered into provision of financial services could potentially be another source of disruption in the financial system. They offer big opportunities, at the same time they carry risks which need to be properly assessed and dealt with. As you would be aware, such companies, whether from e-commerce, social media and search engine platforms, ride-hailing and similar other businesses have started to offer financial services in a big way on their own or on behalf of others. And the others could be banks or NBFCs. These companies have an enormous amount of customer data which has helped them to offer tailored financial services to entities and individuals lacking credit history or collateral. Even the banks and other lenders are sometimes using these platforms provided by fintech companies in their internal processes for credit assessment. Such large-scale use of new methodologies in credit assessment can create systemic concerns like over-leverage, inadequate credit assessment, and similar other risks. Authorities and regulators have to strike a fine balance between enabling innovation and preventing systemic risks. The big techs also pose concerns related to competition, data protection, data sharing, and operational resilience of critical services in situations where banks and NBFCs utilize their services. These concerns can also materialize in sectors other than financial services. The provision of financial services through the digital channel, including lending through online platforms and mobile apps, have brought in issues relating to unfair practices, data privacy, documentation, transparency, breach of licensing conditions, etc. The Reserve Bank will soon be issuing suitable guidelines and regulations to make digital lending ecosystem safe and sound while enhancing customer protection and encouraging innovation. Now, the question arises, what kind of regulation and supervision should the central bank and other regulators have in their respective areas? The need for fintech regulation emanates from the challenges they pose to the financial system and the new risks they carry. These risks have a bearing on overall financial stability and market integrity. The approach to regulation of fintech could be by way of activity-based regulation, wherein similar activities are treated similarly regardless of the legal status or nature of the various players in that area. It could also be entity-based regulation. So first I mentioned that it could be activity-based regulation. It could also be entity-based regulation, which requires that regulations are applied to licensed entities or groups that engage in similar and specified activities. The regulation can also be outcome-based regulation by setting out some basic common and technology or business model neutral outcomes that the entities must achieve. So it can be, as I said, activity-based regulation, it can be entity-based regulation, or it can be outcome-based regulation, or a mix of all. India has traditionally followed a hybrid form of regulation that combines activity and entity-based regulation. As a principle, the Reserve Bank has been applying comprehensive regulatory, supervisory, and oversight requirements to various segments of financial sector in its domain to create an enabling ecosystem for such activities to grow in an orderly fashion. Going forward, the Reserve Bank will continue to fine-tune its regulatory and supervisory measures, keeping in mind the evolving dynamics of the financial sector. Now, does regulation require collaboration with different kinds of regulators? Is it necessary for one regulator to collaborate with other regulators within the country and in other jurisdictions? When it comes to technology, it may transcend regulatory or national boundaries. The most relevant example in this case would be the blockchain technology. Different blockchain platforms cannot be limited to a regulator or to a nation. Another example can be the case of decentralized finance, or as they call DeFi, in which financial applications are processed on a blockchain with limited or no involvement of centralized intermediaries. DeFi poses unique challenges to regulators as its anonymity, lack of a centralized governance body, and legal uncertainties can make the traditional approach to regulation somewhat ineffective. There is therefore a case for a globally coordinated regulatory approach and inter-regulatory coordination to enable comprehensive assessment of such activities and mitigation of risks. In this context, before I sort of close, I would like to just highlight some recent initiatives which the Reserve Bank has taken in the area of both regulation and supervision. And I would like to focus more on the supervision aspect, because on regulation I have already touched upon that, howsoever cursorily. In the specific area of cybersecurity, the RBI has recently conducted phishing simulation exercises for select supervising entities to assess their email security standards and cybersecurity preparedness. We have also initiated the process of conducting cyber reconnaissance exercises this year. This is a new thing which we have started this year. This will provide preemptive information on cybersecurity vectors of the supervised entities of the Reserve Bank of India. Cyber drills, which are conducted periodically by the Reserve Bank hitherto, are now being further enhanced in terms of coverage and the periodicity. The increasing use of technology and digital services has led to more incidents of digital frauds and customer dissatisfaction. The recommendations of the RBI working group on digital lending in this area are under very advanced stage of examination, and the guidelines, as I mentioned a little while ago, will be issued very shortly. In the context of customer service, another area which is engaging, and it is engaging our serious attention, is the harsh recovery methods used by certain lenders without having adequate checks and controls over their recovery agents. We have received complaints of customers being contacted by recovery agents at odd hours, even past midnight. There are also complaints of recovery agents using foul language. Now, such kind of actions by recovery agents are unacceptable and pose reputational risk for the financial entities themselves. And this is something which we find to a large extent in unregulated entities, and also to some extent in the regulated entities of the RBI. The RBI will sort of address this issue very seriously, in all its seriousness, so far as our supervised and regulated entities are concerned. With regard to the others, when we get complaints, we of course pass it on to the law enforcement authorities to take the necessary action in that regard. We have taken serious note of such instances and will not hesitate to take stringent action against the errant regulated entities. And this is one area where I must also mention that the banks in particular, I mean in our engagement with the banks and other large NBFCs, we have sensitized them and they are sensitive to these issues and they are taking action. But every day is a new challenge, and I would urge all financial sector players, all lenders, to give special attention to these areas, because the kind of customer interface has to be within certain parameters and within certain broad parameters and framework. We have recently set up a committee to review customer services standards in the RBI regulated entities, which would inter alia review the emerging and evolving needs of the customer service landscape, especially in the context of evolving digital financial services products and their distribution, and suggest measures which the RBI can consider and adopt. Now, in the area of, in this entire fintech area, there are issues of governance, there are issues of risk management. It's all there in my prepared text, but I think I will just skip the various issues broadly. The governance in all these entities, that is, whether they are banks or NBFCs or other lenders who are participating in the area of fintech or fintech companies themselves, will have to have adequate governance and appropriate governance frameworks. A good governance structure will have to be supported by effective risk management and compliance functions. The global financial crisis was preceded by a wave of financial innovations related to securitization and other innovations, especially innovative financial instruments. These allowed the financial system to grow at a pace that was beyond the capacity of the financial sector and the financial sector entities to manage, especially from the point of view of the connected risks. Given such past experience, prudence demands that introduction of innovations in the financial system should be done responsibly and in a calibrated manner, taking into account the capacity of financial entities to manage the potential risks. It goes without saying that innovations which provide opportunities through high risk taking need to be managed by sound corporate governance and risk management. The senior management and internal control mechanisms in financial institutions should also ensure that their IT systems are robust and transparent and are not open or prone to manipulation that may camouflage the true state of affairs in the organization. Let me conclude by saying that we are in the midst of a technological revolution in the sphere of financial services. Technology and innovation per se are neither destructive nor constructive. It is the use cases that present the responsible or the irresponsible sides of any particular innovation or technology. Reserve Bank shall continue its approach where innovations which provide benefits to society are encouraged without compromising the stability of the financial system. The trend of technology-driven changes in the financial services sector will continue in the future. Participants and players in this sector will have to strive hard to remain relevant in the ever-changing economic environment by continuously improving the quality of their governance, reworking their business strategies and business models, designing products and services with the customer in mind, ensuring operational resilience and risk management, and focusing on more efficient products and services by leveraging on technology. The possibilities are immense only if we are ready to embrace them while meeting the challenges. Thank you.
Thank you so much, sir, for your insightful talk. I would now request Mr. Shyamal Mazumdar, Managing Editor, The Financial Express, to join us on stage and take questions from our esteemed audiences. A very warm welcome to you, Shyamalda. So this is your chance. If you have any questions, please raise your hand. Can I request you to come to the first table right here? First table. Sir, may I request you to please raise your hand? Yeah, the mic is coming to you.
Good morning. Am I audible? Yeah. Thank you, sir, for this encouraging address, and it is so very encouraging to see the regulator talk about various forms of regulation. So you talked about entity-based, activity-based, and outcome-based regulation. There is another school of thought in terms of the ultimate user or the borrower segment-centric regulation, because I say this especially in the context of the pandemic and the certain conditions. The small borrowers are the ones who get affected the most, and especially in the context of prudential regulations being same across the board for a small and big borrowers. Is there a case for having some special dispensation apart from the event-based, but on an ongoing basis, if we can have some kind of a borrower-centric regulation, because the even technology today, when the advent we see, it is the ultimate user who is at the focus. So your views on this?
I think I must say that my address perhaps became a bit heavy in a very warm, bright morning. We have a bright morning today in the monsoon season in Mumbai. So, but I decided that since this event is focusing on modern BFSI, I decided that I should focus more on fintech. And as I mentioned, a copy of the speech will be uploaded in the RBI website. So those of you who are interested can look at it. But specifically addressing your question, you see, we have, in the case of NBFCs, we have already introduced scale-based regulation. And in the case of MFIs, very recently again we have introduced activity-based regulation, which is neutral across entities. If it's a microfinance loan given by a bank or a MFI or another NBFC, the regulations are now uniform. It is targeting the size of the borrowing of the micro borrower. So therefore, we are already on that track. And when we introduce, what we call activity regulation, the activity is linked to outcome. So we want to see that eventually the micro sector borrower, the microfinance borrowers, they benefit and their interests are taken care of. At the same time, the banks also and the lenders, whether it's an MFI and the banks, they have to also take into account the customer's requirement. We have, for example, made some changes with regard to assessing the income criteria of the, of the microfinance borrower. So all these have been done taking into account. At the end of the day, all these have been taken, all these have been framed keeping in mind the requirement of the ultimate customer. So we are very much on that track. As and when any new or constructive suggestions they come up, we will certainly look at it. And as I said, that the RBI will continuously strive to fine-tune its regulations because it's an ever-changing situation. And we will respond proactively. We will try to be as proactive as possible. So if there are new suggestions or if there are new challenges or new trends and developments, the RBI will certainly respond to it.
Thank you so much, and I'm sure there will be a lot of questions, but I'd here like to ask Shamulda to take over and continue with the session. Thank you so much.
Thank you, Governor. I think your speech was just wonderful, where you spoke about the fine balance between, fostering innovation and preventing systemic disruption. But my questions are a little away from that. Firstly, on this easy liquidity, sometime back you had said, and I quote, that the day we announced that we will enter that Chakravuh, we planned an exit route also and we would come out smoothly. Is exiting the Chakravuh proving to be more difficult than you had imagined earlier?
The certain developments which took place after we announced certainly made the task more challenging. I'll explain how. In the beginning of the COVID-19 pandemic, in fact, I remember on 27th March 2020, we announced our first set of measures. 27th March, then I think it was thereafter 17th April, and then 22nd May and 6th August. I remember these dates very clearly. So whenever we announced any liquidity infusion measures, there was a sunset date, there was an end date. The TLTRO was for 1 year or it was for 3 years. The reduction in the CRR was for 1 year and it ended at the end of 1 year. We of course gave 1 month extension, but it ended at the end of 1 year. So each injection of liquidity was accompanied by a sunset provision and end date when it had to come back, when the liquidity had to sort of come back. But liquidity to the market also gets added from other sources. For example, when there is, the RBI intervenes in various markets, or whether it is the GSEC market or in the Forex market, this is a part of our normal operations. That also generates a lot of liquidity. So therefore, if you remember, in I think January 2021, even before the first year of COVID was completed, we announced our, this VRRR, that is the variable rate reverse repo auctions. And we tried to sort of take out the liquidity, sterilize this liquidity. Sterilize is not the right word, but to sort of sequester it and keep it, in the VRRR window. Then the process got interrupted by the Delta wave. Delta wave came around April, it subsided, but our VRRRs continued during that process. And then as we move towards end of 2021, we had the Omicron. And then, of course, on February 24th, the war has started. So what we said at the beginning is that our approach was that we will provide sunset clauses, no injection of liquidity will be open-ended, but the liquidity which came into the system beyond our control, that we had to deal with it. And I think the VRRR has been able to deal with it. The SDF has been able to deal with it. Now we see some kind of, now we see a good, I would say reasonably satisfactory credit offtake also happening. The credit offtake is about 12% as per the year-on-year growth is 12% as per the latest data. And it was last year around this time 5 or 6%. So with credit offtake, a part of the liquidity also will get absorbed. So therefore, the process has taken little longer because of developments like the various waves of the pandemic and the onset of the war in Europe. But as I am speaking to you, the total liquidity in the system, I have given the numbers actually in my last monetary policy statement. If I can recall correctly, in the pandemic time, we injected a total liquidity of about 12.5 lakh crores, of which about 5 and 5 lakh crores, 5 and 5.5 lakh crores have come back, and there is 7 lakh crores sitting out there. That 7 has also now come down to about 5 lakh crores. And most of it is now getting absorbed in the SDF and in the VRRR. We have to leave something in the market also, which the banks and the lenders must have to go on with their credit lending activities. So I would say that the process of getting out of the Chakravyuh has taken a little longer because of things which happened beyond our control. Even at this point of time, we remain confident that we will come out of it very smoothly, and we are targeting a soft landing.
Okay. Over the last 2 days, central banks like Fed and Bank of England and many central banks in Europe, they have become more aggressive in hiking rates. While at the same time, some of them acknowledge that the risk of recession still remains uncomfortably high. Now, the two questions. One, did RBI delay the rate hike cycle because it felt that the economy is too weak to handle that kind of a situation? And second, now that the rate hike cycle has started, do we see a more aggressive RBI going beyond the pre-pandemic level of 5.15?
I truly and sincerely believe that the RBI is in sync with the requirements of the economy, that the RBI is in sync with the with the trend of economic developments and the process of recovery and whatever you call the curve. We are very much in sync with the requirements. I'll take a little longer to explain this, to sort of reply this question. As I mentioned a little while ago, even as early as the beginning of 2021, we had started to take out the liquidity. And then the Delta came, and then the other challenges which I have talked about. Now, our primary focus when the COVID started in the first quarter, our GDP contracted by a historic high of 24.4%. That was the first quarter, and that year, that is 2021, the economy witnessed a contraction of 6.6%. Our focus was to support growth, to see that the financial markets remain functional. And let me remind that even after the global financial crisis, with the onset of global financial crisis, there was no activity in the financial markets for the first 15 days or so. Everything had frozen. This time around, when COVID started, when the nationwide lockdown started, I think it started on 25th March, we announced our measures on 27th March, the financial markets remained fully functional. All the financial market infrastructures, they remained fully functional. We ensured that The financial, there was, liquidity, which is the lifeline of a financial system, that was provided adequately. So our focus was to maintain financial stability, to see that the financial markets function normally, and to support the process of economic revival. And that approach continued through 2021 and in 21-22 also. During this period, there were situations where inflation crossed 6%, but we decided to look through them because we realized that this inflation was transitory and it will come down. In August last year, 2021, we stopped describing the inflation as transitory because there was realization that inflation was becoming persistent. Core inflation was becoming persistent, and several other areas we realized that inflation was becoming persistent. So in August, we stopped calling it transitory. Thereafter, we focused on liquidity withdrawal. The GSAP, which we had announced in April, around 4th of April last year, it ended on 30th October. And thereafter, we did not announce, any fresh GSAP. We focused more on Operation Twist so that additional liquidity is not injected into the market. So right after, from September, October onwards, we focused on withdrawal of liquidity, and we were watching the revival of economic activity and the revival of growth. In fact, in one of my monetary policy statements, I had said that when the shore is visible, why rock the boat? Let us first, reach the shores safely. So our focus was to ensure that the economy reaches a stage where we can pull out the support in terms of liquidity and the support in terms of lower interest rates, which we had given to deal with the fallout of the pandemic. So we wanted growth to reach a particular level where we were comfortable that it was stable. Questions have been asked that, that our February, I'm not being defensive, I'm just stating certain facts. Questions have been asked that our projection of inflation in February this year was very optimistic. We projected 4.5% for the whole year. Now, I will tell you why it was not optimistic. The professional forecasters, their conclusion was it was going to be 5%. We had done our internal analysis. In fact, that time we had assumed the crude oil prices to be $80 per barrel. And that was the one we adopted for our projections. Internally, we did analysis if the crude oil was to touch $90, $95 or $100 per barrel. Even then, we found that the inflation will be about 5 or 5.2%. So we took a conscious call that let us tolerate for little more time, see the year end, let's close the year 21, 22, and 2 years of support. Let us see what has been the outcome. We will get a quick sense out of it, by the end of March, and then we will act. So therefore, reaching the end of March, we concluded that activities and GDP size and growth had exceeded the 2019-20 level, the pre-pandemic level. So we decided it was now time to focus more on inflation, and therefore in the April policy we introduced SDF at a higher rate, by increasing the, it was higher by 40 basis points compared to the reverse repo rate. We changed our inflation projections. We very clearly came out with the policy statement that from now on, we will, in the sequence of our priorities, inflation takes priority over growth. And then the inflation number which came for, the inflation number which came for April, we got a sense that it is now becoming, it's going to be much more than expected. And in the meantime, the war has started. Now, the war came without any forward guidance or any advance notice. Nobody knew that the war will start. Even as late as 20th or 21st February, everybody was saying that, okay, it will be a geopolitical conflict. Nobody expected a full-fledged war and its consequences. In April, we knew that this war is going to cause damage. We came out with about 5 or 6 measures. We increased the rate, the overnight, we increased the SDF rate. We introduced SDF at a higher rate of 3.75, which had the effect of, increasing, pushing up the overnight call rates, which is the primary instrument of monetary policy. We changed our focus to inflation. We revised our, projections of inflation. And in April policy, indeed, there was a rate hike of 40 basis points because the SDF at 3.75 ensured that the call money rates went up by an equivalent amount. On top of a 40%, on top of a 40 basis point rate hike through the SDF, we did not want to add another 50 or 40 basis points of rate hike because the shock would have been too much. The shock that the war gave had to be dealt with in a calibrated manner. Just as the shock which COVID gave to our economy, our financial markets had to be dealt with in a calibrated manner, the shock of the war had to be also dealt with in a calibrated manner so that the shock is well absorbed by the players, by the businesses, by the financial sector, and by the lenders. So we had a calibrated path, so therefore we did the off-cycle meeting in May, and now the numbers, growth numbers for last year, they are about 1.5% higher than 2019-20 level. So I feel that we are very much in line with the requirements of the time. The RBI has acted proactively, and I would not agree with any perception or any sort of description that the RBI has fallen behind the curve. Just imagine if we had started increasing the rates early, what would have happened to growth? This is all hindsight knowledge. If we had started increasing the rates a little earlier, what would have happened to growth in 21-22? And could it have prevented, I mean, rhetorically I can say, that could it have prevented the spike in inflation which has now been caused by the war? No. Inflation would still be at 7%. So the assumption that RBI should have increased the rates another 3 or 4 months early, let us look at the economic cost that it would have caused to the economy. And then I think it would be fair to reach a conclusion only thereafter. I'm sorry, I've taken a very long time, but this question is being asked in several quarters, so I thought I will address this question in a slightly detailed manner. I mean, slightly detailed is an oxymoron, but in a detailed manner.
So what is the neutral rate after the pandemic, Governor? Has it gone up or gone down?
No, it will depend on the evolving situation. In the last MPC press conference, I have mentioned, from the point of view of liquidity, I have mentioned when, I have explained that when the overnight rates are, at the level of the repo rate, but that is more from the point of view of liquidity. It all depends on the inflation dynamics. It will depend on the inflation scenario, how it is panning out. Every day there are new developments taking place, and yesterday the US Fed has increased its rates 75 basis points, and the earlier expectation was 50. They have done 75. So it will depend on the evolving situation. The RBI is very watchful of the evolving dynamics on inflation, and we will respond to it appropriately. It's very difficult and not possible for me to sort of pinpoint a specific level of but even now we are having a negative interest rate, but our negative interest rates, incidentally, we are far better off compared to some of the advanced economies where the negative interest rates are even much higher.
Sorry, my last question, and the audience can take over. I am referring to recent, this week only, an article by former Chief Economic Advisor in Indian Express, our sister publication, wherein, I'm not getting into the details, when he made one comment that the mistake, I'm quoting, that the RBI made was treating the ceiling as a floor. That 6% ceiling became its floor target. How do you respond to that?
No, I don't want to enter into an issue with, sorry, I have not seen that article. I must confess, I don't want to enter into any sort of debate with anyone. But we have ourselves said, we have a regime of flexible inflation targeting, where the target is 4%, and there is a band around it, plus minus 2%. And that range of 2 to 4%, that is the range available to the regulator to deal with extraordinarily challenging situations as it came out during the time of the COVID. During the time of the COVID, the Monetary Policy Committee consciously decided to tolerate an inflation which was higher than 4% up to 6% because because the situation required that. If we had been very firm in maintaining 4% and kept the rates unduly high, I am sorry, the consequences of that approach would have been disastrous for the economy. Central banks across the world, but I will not talk about others, I will talk about RBI and our Monetary Policy Committee. We decided to use that band, the flexibility available to us around 4% to support growth. And we are very open about it because the cost and the damage to the economy, you analyze two scenarios. One is we maintain 4% inflation. The other, we focus on growth when the economy was facing extraordinary challenges. If we had attempted to keep our monetary policy tighter at that time, the economic damage that it would have caused to our economy and to our financial markets would have been enormous. And it would have taken years for India to come back. We are a country of 130 crore people. We have to also give priority to growth. And the way the law is defined, it was not MPC's discretion to operate, to sort of tolerate inflation up to 6%. It was not MPC's unilateral decision. Look at the provision in the RBI Act. The provision in the RBI Act says that the RBI shall maintain price stability defined in terms of 4% plus minus 2. The RBI shall maintain price stability while keeping in mind the objectives of growth. So we are required under the law to keep in mind the requirements of growth. The economy contracted by 6.6%. If we had adopted a more, if we had adopted a tighter policy, then it would have been sort of disastrous for the economy. And also another area which I must point out, that going by past experience, our response this time around was very calibrated. The injection of liquidity, as I mentioned earlier, was not open-ended. There were withdrawal clauses built in. Even the COVID resolution package, which we offered on 6th of August, that is for restructuring of bank and NBFC loans, etc. Even there we had set out parameters with regard to what kind of debt equity ratio it should have and what kind of financial parameters and operational parameters should be sort of the borderline beyond which it should not be done. So we were very careful and calibrated even while loosening monetary policy. But tolerance of a higher inflation during the pandemic was a necessity, and we still stand by our decision. And I think it was the monetary policy's, MPC's decision to tolerate higher inflation, which definitely, among other factors, contributed to the revival of economy and to a place to put our economy where we are today, where, as our bulletin article has said yesterday, India is much better placed than many other economies to face the fallout of the war.
Thank you, Governor. We can have a couple of questions from the audience, please.
Governor, yeah, thank you for taking the questions. So, in the context of fintech, as you were telling us, how do you envisage the existing banks setting up separate digital banks, as distinct entities? How do you see that, and how would the RBI view that? Because it would help them in terms of branding, putting in brand new technology. So have you already received applications?
No, actually, we don't have separate regulatory framework for what is called as digital banks. Two things are happening. Number one, we have come out with regulatory guidelines for digital banking units, DBUs. You are familiar with that. And the banks themselves are also adopting technology in a big way. So I feel there is no need for any bank to set up a separate digital bank, to have a parallel entity sort of in the same business. What they can achieve by having a parallel entity, they can very well achieve as a part of their own organization. So the idea of a separate digital bank, there were some suggestions which came, but we felt that that carries certain risks with it. So we have therefore not accepted that at the moment. And but the banks are free to change their business model and to focus more on more on harnessing technology for delivery of various banking services.
Just a follow-up question on neobanks. Where does RBI stand on this, and could we expect some regulations soon?
No, at the moment there is no proposal as such, because we feel that the existing banks and the NBFCs can adopt more and more of technology and achieve the outcomes which technology, to sort of exploit and capitalize the opportunities which digital transactions or new technology is offering them. So at the moment we have no idea of setting up what may be called neobanks or digital banks, because we feel that the existing architecture is sufficient to enable the existing players to leverage on technology and the innovations.
And how soon can we expect the regulations for big tech participating in our financial system?
You see, again, I think big techs are already participating in this financial system. One, by way of partnership with banks. There we are trying to see that the banks or NBFCs, there we are trying to see what are the kind of terms and conditions of the agreement between the bank or the NBFC and the big tech company. Because there are only certain things which the banks can outsource, and there are certain things which the banks cannot outsource. So that is one aspect which we are looking at. So far as big techs are concerned, there are various forms of lending which have now started. Now, for example, if you call buy now, pay later, which is now offered by several e-commerce companies, that also involves in a kind of a lending activity. But we have to be very careful and calibrated in our approach. We should not suddenly start interfering everywhere and allow things to sort of whatever is happening. Like for example, if an e-commerce player is giving opportunity of buy now and pay later, let him carry on with that business. What is our responsibility as a regulator is that we keep assessing what kind of leverage is building up in the total system, and is it going to pose a challenge to at the systemic level. So we watch very clearly the major players, what kind of buy now, pay later they are offering, what kind of leveraging they are doing, because eventually if a real sector business fails, it impacts the banking sector also. So we are studying all these details very carefully to the best of our capacity. As and when required, we will come out with guidelines, but to begin with, we don't unnecessarily, before it really reaches a place where it causes it would cause worry. I mean, at a very incipient stage, we should not interfere and kill some new business methods or models. We have to allow businesses to grow. We have to allow new business practices and methods to grow. And we step in only when we feel that, well, it's now time for the regulator to intervene.
And lastly, sir, on the NUE guidelines, how soon can we expect that? Or if you have any views on the applications?
No, not at the moment. I think you will hear about it. We are the matter is under consideration, and we will sort of come out with some decision.
Thank you, Governor.
Just,
I am okay, but I'm eating up into others' time. I think
no,
Anant,
not at all.
Anant and
Just
others.
one last question, Governor, one.
Just one quick point. I'm from Financial Express. We have also the chief economic advisor here, and this is an era of coordinated approach which is happening. Do you both always agree?
No. But
Where do you differ then?
no, but let me mention, we do not agree always. I'm saying we do not agree always, but we also agree on many points. Wherever there are disagreements, which is quite normal between any fiscal and monetary authority, wherever there are differences of opinion, we engage internally and resolve them.
Thank you so much.
Don't
gentlemen.
carry the headline tomorrow that the CA and the governor, they do not agree. So we do agree on most of the points.
But-
Wherever there are differences, they are sorted out.
Sridas, you are actually also very sure-footed in uncertain times. And one former governor once told me that it's better to be vague and accurate than be precise and wrong. You are never vague, and you are always, you are never wrong as well and never vague. Given the current scenario, when do you think we could be touching 4% inflation? I know it's very difficult to say, but in the current environment, given your understanding of how things are, what's the sense you get?
We have given our inflation projections. I cannot say anything beyond that because we have now given our inflation projection for the current year, 6.7%. We keep on internally analyzing it. There are so many uncertainties. In fact, I think it all depends on, how quickly the war ends, how quickly the COVID ends. So we are looking at a totally uncertain future. But from our side, we have made our assessment in a one-year horizon, and we also have our internal analysis about what lies beyond, and our decisions and monetary policy actions are suitably calibrated to respond to that and bring back inflation. I have said it earlier also, to bring back inflation to, to the target level. And we have to do it in a manner so that the process of economic recovery is not, not jeopardized. That also has to be kept in mind. But priority obviously at the moment is inflation.
Thank you so much, gentlemen. May I request